Hello everyone, it's Darren from Naked Forex Now and Trade with 60. I want to do a video this morning about trading mindset, and sometimes it's just kind of good to question how we think about trading, because some sort of errors in thinking can lead you to make bad decisions about how you trade. Now, the first thing to consider is how do most people enter the market. And if you look at all of the different variations of techniques that people use to enter the market, they essentially boil down to one simple idea. And that idea is that price was going in one direction. Let's say price is going up, and now there's some indication that price is going to go down, and then people sell. So you can apply this to price action, trend lines, head and shoulders patterns, oversold, overbought, engulfing bars, moving averages. However you wrap it up, essentially people are just waiting for price to change direction, and then they're either buying or selling with that new direction change. That's all entries. All entry systems basically boil down to that one core idea. And obviously the particular combination of elements you use, you believe that that is has a good probability of the change in direction continuing. Okay, so that's logical. That makes sense. I mean, you want to sell at a high when price changes direction and goes down. It gives you're essentially getting a good price to sell then. Now the problem comes is that when people decide to exit their trades, they suddenly decide to use different criteria. Because if you're selling because there's a change in direction, then when you exit your trade, it should also be because you believe there's a change in direction. If you're selling and you don't believe that price is going to go up, why are you exiting your trade? And when it comes to the exit, people seem to rely on different criteria. So in other words, what we're saying is when you're exiting your short trade, then you should have some sort of evidence or belief that price is now going to go up. And if that is the case, then why are you not buying? Why are you just closing your short and not buying? Now you know, some people might argue, well, I'm in a short sell and I'm reading price action. That's telling me that price is going to go up a little bit before continuing down. Well, if that was the case, then why aren't you still holding your short? Why aren't you just holding through this little retrace that your read of the market is telling you, and waiting for price to continue on down? And then people might argue, well, I'm reading the market now and it's saying it's undecided. Well, you should still stay in your short trade, surely, until you read the market and it's telling you convincingly that price is going to go up. And then you should close your short trade and go long. So if you believe that your exits are good exits and you're exiting a short trade and you're not going long, then you need to question your ability to read the market. And I know there are ways to trade where you don't need to read the market, where that isn't your approach, okay? But if it is, okay, and you're saying that you're exiting because you're reading the market's going to change direction and you're not going long, then really deep down, how much belief have you got in your ability to read the market? Now, my approach is that you can't read the market. It's always uncertain, and really it's more about managing your winning trades than an ability to predict where price is going to go next. And that's also why I've distilled my entry and exit signals to essentially one bar change in direction. Now, people will believe that a more complex entry and exit system, reading price action combined with support and resistance and overbought and oversold, momentum, all these things essentially give you an edge. But you can essentially boil all of these down to a single change in bar. But generally, people are deciding to look at the charts in a different way, so it gives them more belief because it's more complex and that's easier to believe. So, just as an example here, let's say this is the 4-hour chart. Let's say we traded trend lines. Okay, I'm not going to draw a really good trend line because I'm just trying to make a simple point here. But let's say that we traded this trend line here. Okay, so what we're doing is we're looking for price to break that trend line. Okay, and then we're looking to get into a sell. Okay, and that might be you wait for a retrace and sell here and place your stop over the high here. Okay, now you believe that this this particular pattern is showing that sellers are coming into the market and price is going to continue down, and indeed it did. But if we go to a higher time frame, and bear in mind that everybody's looking at different time frames, let's go to a higher time frame, say the daily, and then let's have a look at the same scenario. Okay, so on daily we don't get it. Let's go up one more to a weekly. Okay, so on the weekly, what we can see has happened was we had a bar close up, which is the uptrend, and then we had a bar close down. So really all that's happened with your trend line break and retrace is the direction of the closes of the bars has changed from up to down. Okay, so just changing a direction change in a bar on the higher time frame is exactly the same as this watching for a trend line on H4. Okay, but this is more complex. Okay, just visually it's more complex, and that makes it easier to believe that it has high probabilities. Okay, let me have a look at another example, say a popular let's go back to the same example. Another popular way of entering the market is to wait for a pin bar, okay, that sticks out at the top, closes right down near the bottom. Okay, it's a nice visual swing high. Okay, now this is considered significant. Okay, but if we go back and look at it on the lower time frame, what is actually going on there? Okay, and all that is going on is price swung up and it swung back down and it closed near the bottom of the swing. So this swing here is essentially a pin bar, and this swing here is a pin bar. Okay, but it's just the pattern of the open and close that make it appear significant visually to you. This here, price swings up and swings down and closes near the close. On a higher time frame with the right start and end time, it's going to look like a pin bar. Okay, likewise this swing here. Okay, so why aren't we just waiting for price to go up and waiting for price to come back down and then selling here? See, not most of these on the higher time frame won't appear as pin bars. Okay, a lot of them will just appear as price was going up and then it closed down and you sold at the break of the low. Okay, price was going up and it closed down, you sold at the low. Price was going down, it closed up, you bought at the break of the high. Okay, so again, patterns that appear significant are mostly appearing significant because they are visually enticing. They're appealing to the eye, and that makes them easier to believe. Okay, but essentially we're all waiting for bars that are closing up to change and close down, and then we're looking to sell. Okay, and what will really decide whether you make profit in the long run, well, that's probably not true. What is easier to make profit in the long run, okay, is to see the particulars, the small details of the entry as not being so significant. It's how you manage those trades over the long run, and that, I believe, is easier for human beings to learn and to get good at than it is to live in a world where you think your ability to read the market is going to make a difference. Okay, it's all about logic and being rational and seeing the market for what it is. Let's remember that what we see visually here is a result of how we display the information with candles. That's what makes the patterns. Okay, if you take the candles away and you just look at the line, you can see it's random walk and levy flight, random walk, levy flight, random walk, levy flight, random walk, levy flight. Okay, you compare 10 different markets and they'll all look like that. Okay, because that's how markets move. When you compare a market to a random generated chart, you cannot tell the difference. Okay, so that's just just to have a think about your mindset about trading, how you enter the market and how you exit the market. And remember, when you're exiting your winning trade, okay, you should be confident to reverse it and go in the opposite direction. Now, obviously, if you're a trend trader and you've decided that you're only trading long, then that's fair enough. But as soon as there's an indication that the trend has changed, then you should be trading short. And it's no different for any type of entry. That should always be the case. And if not, you need to question your logic for entering the market in the first place. Okay, enjoy the weekend. I will speak to you all soon. Comments below, please.